What is happening, future drivers and tech enthusiasts? Welcome back to Electro Drive News, where we're always on the pulse of the electric revolution. The pace of innovation never slows, and this week is no exception. We've got updates that are set to reshape your understanding of what's next in mobility. Get ready to buckle up, because the future is arriving faster than you think, and we're here to break it all down for you. From game-changing market entries to crucial financial insights, the landscape is shifting, and you won't want to miss a second of it. We're diving deep into the stories that matter, the ones that will define the next era of transportation. So, stay tuned, because the electrifying news starts right now. First up, a major player is making bold moves, potentially signaling a significant expansion that could impact markets far and wide. Get ready for some truly disruptive developments. Then, we're hitting the brakes to analyze some surprisingly stark figures that reveal a critical shift in brand performance, leaving everyone asking, what's next? And that's not all. We're also looking at a brand that's not just entering new territories, but is poised to bring its entire family of vehicles to a whole new continent. Finally, we're dissecting the financial pulse of a key industry leader, digging into the numbers that could tell us where the market is headed. You're watching Electro Drive News, so make sure you're subscribed and have that notification bell on so you never miss an update. Market entry confirmed, a new continent beckons. This development signals a significant strategic move for a major automotive player, potentially reshaping the competitive landscape in a key global market. The approval of its budget EV model for local certification is just the first step in an ambitious expansion plan. More than just a single model, the company intends to introduce its entire brand portfolio, including its luxury and mass-market offerings, to this new territory. This comprehensive rollout suggests a deep commitment to capturing a significant share of the burgeoning electric vehicle market in the region. The company's leadership has expressed strong interest and has been actively engaging with potential local dealership partners, indicating that the groundwork is being laid for a substantial presence. This expansion is not merely about selling cars. It's about establishing a full ecosystem, potentially including charging infrastructure and after-sales services, mirroring strategies seen in other mature markets. The anticipation is palpable as the brand aims to leverage its innovative technology and diverse product lineup to attract a new customer base. The initial focus on the budget-friendly model, which has already secured the necessary certifications, suggests a phased approach, starting with a more accessible entry point before introducing the higher-end vehicles. This strategic move is expected to create significant buzz and potentially disrupt established players who have long dominated the automotive scene in the target region. The company's commitment to bringing its full suite of brands underscores a long-term vision for global growth and market penetration. This expansion has generated considerable excitement among automotive enthusiasts and potential consumers in the new market, with many eagerly awaiting the official launch dates and pricing details. Analysts are closely watching how the company's unique business model, particularly its emphasis on technology and customer experience, will translate to this new environment. But what does this global push mean for sales figures on the ground? We're about to dive into the latest performance data that might surprise you. Sales figures reveal a stark decline, brand performance under scrutiny. In a surprising turn of events, a prominent electric vehicle manufacturer has reported a significant year-on-year drop in sales for its core brand during August. This comes despite the company achieving a new record for overall global monthly deliveries, a milestone largely attributed to its newer, more affordable sub-brands. The core Nio brand saw its deliveries plummet by 47.8% compared to the previous year, with 10,525 units sold in August. This figure fell short of analyst expectations, continuing a trend of declining sales that began in April. Since then, the brand has experienced consecutive monthly contractions, with figures showing a 35% drop in May, 31% in June, 38% in July, and the steepest decline of 48% in August. This marks a considerable challenge for the premium mark, especially as the company aims for ambitious sales targets in the final quarter of the year. To meet its goal of around 25,000 monthly sales for the Nio brand, deliveries would need to more than double from current levels, requiring an increase of approximately 137%. However, there are signs of potential recovery. Dealer feedback indicates a surge in new order intake, with August orders reportedly jumping 120% month-on-month. These orders are spread across the company's brands, with a substantial portion allocated to the mass-market Onvo brand, which has quickly become a growth engine following the launch of its L90 SUV. Onvo was responsible for over 10,000 units in August. The company is also banking on the upcoming launch of its third-generation ES8, scheduled for the latter half of September, to revitalize sales for its premium lineup. To bolster demand in the interim, Nio implemented measures such as equipping all its models with a 100 kWh long-range battery pack as standard, while keeping starting prices unchanged, effectively reducing the cost for buyers. The company had previously refreshed several of its core brand models without price increases earlier in the year. This significant disparity in performance between the core Nio brand and its newer sub-brands highlights a key strategic challenge for the company. While the mass-market models are gaining traction, the premium Nio brand is struggling to maintain its sales momentum. The market is keenly observing how the upcoming ES8 launch and ongoing sales initiatives will impact the brand's trajectory in the coming months. As sales figures paint a complex picture, another piece of news suggests the company is looking beyond domestic challenges. We'll explore where this ambitious brand is setting its sights next. Global expansion confirmed, Nio sets sights on Australia. The Chinese electric vehicle manufacturer Nio is officially planning a significant expansion into Australia, with its entire range of brands slated for a local debut. This ambitious move follows the Australian Design Rule (ADR) certification of its Firefly electric hatch, granting it the green light for a local launch, expected around 2026. However, the company's vision extends far beyond the Firefly. Nio's co-founder and president, Lihang Qin, has confirmed that both the premium Nio brand and its mid-tier Onvo spin-off are also destined for the Australian and New Zealand markets. Qin expressed the company's familiarity with these regions and its close attention to their automotive landscapes, noting ongoing discussions with potential dealer partners. He encouraged consumers to consider waiting for Nio's offerings, highlighting the diverse lineup that includes the luxury Nio brand with 8 models in China, the Onvo brand featuring models like the L60, a rival to the Tesla Model Y, and the Firefly, which currently stands as the group's sole model to achieve ADR status. The Firefly, tipped to launch with a price point around $35,000 plus on-road costs, will compete in the more accessible segment of the EV market. It is equipped with a 105 kW/200 Nm single electric motor, rear-wheel drive, and a 41 2 kWh battery, offering a range of up to 330 km. Performance figures include a 0-100 km/h sprint in 8.1 seconds, with DC fast charging capable of replenishing the battery from 10% to 80% in 29 minutes. Standard features are expected to include LED headlamps, a 13.2-inch infotainment system, a 6-inch digital instrument cluster, heated and ventilated faux leather seats, a 50-watt wireless charging pad, and a 14-speaker sound system, alongside advanced driver-assist features like auto park. The Firefly also boasts a 404-liter rear boot, expandable to 1253 liters, plus a 92-liter frunk. Notably, the Australian market may not initially see the much-touted battery swap technology that is a hallmark of Nio's operations in China. Nio has been actively expanding its battery swap network, with 4th-generation stations enabling battery swaps in under 144 seconds. While Nio plans to invest in battery swap stations in Europe, with over 30 already operational, there has been no announcement regarding similar plans for Australia. This absence of battery swap technology could be a differentiating factor for Australian consumers compared to those in markets where Nio has a more established presence. The company's strategic entry into Australia, beginning with the certified Firefly, signals a significant step in its global expansion ambitions. This impending arrival has generated considerable excitement, with many anticipating how Nio's unique value proposition, including its diverse brands and innovative technologies, will resonate with Australian consumers and challenge the existing automotive market. While the brand builds its international presence, its financial health is under a microscope. We're now turning our attention to the critical financial data that investors are closely watching. Nio stock performance, a closer look ahead of earnings. As China-based EV giant Nio Inc. prepares to release its second quarter 2025 earnings, investors are keen to understand the company's financial trajectory and stock potential. The current consensus estimate points to a loss of 30 cents per share on revenues of $2.76 billion, indicating a year-over-year improvement from the prior year's loss. For the full year 2025, revenue projections suggest substantial growth, with an estimated $13.7 billion, marking a 50.2% increase from 2024. The projected loss for 2025 is also expected to narrow significantly. However, Nio's earnings history presents a mixed picture. The company has a track record of missing earnings estimates in recent quarters, with an average negative surprise of 33.35% over the last 4 reporting periods. While Nio possesses a Zacks Rank 3 hold, its earnings ESP, expected surprise prediction, is 0%, which, according to Zacks' model, does not conclusively predict an earnings beat for this quarter. This suggests a cautious approach for investors anticipating a positive surprise. Delving into the operational details, Nio delivered 72,056 vehicles in the second quarter, within its projected range, representing a 25.6% increase from the previous year. The core Nio brand saw a decline of approximately 18% in sales compared to the same quarter in 2024, selling 47,132 cars. In contrast, the Onvo and Firefly brands showed stronger performance, with 17,081 and 7,843 units delivered, respectively. This diversification through Onvo and Firefly is crucial for Nio's overall volume growth. Vehicle margins have shown an upward trend, increasing to 10.2% in Q1 2025 from 9.2% in Q4 2024, driven by increased deliveries and cost optimization efforts. On the downside, Nio has grappled with operational inefficiencies, including a significant rise in SG&A expenses, up 46.8% year-over-year in the last reported quarter. Increased personnel costs and marketing expenditures are expected to continue impacting profitability. Investments in battery swapping stations and store expansions, while strategic for long-term growth, have also put pressure on cash flow and overall finances. Nio reported a substantial net loss of $3 billion in 2024, and while losses are expected to narrow in 2025, the target of achieving breakeven in the fourth quarter appears ambitious. The company's long-term debt-to-capital ratio also remains higher than the industry average. Despite these challenges, Nio stock has seen a notable increase of 50% over the past 6 months, outperforming its peers like Li Auto and XPeng. This growth is supported by a strong vehicle lineup and strategic investments in its battery swapping network, which is considered a potential game-changer for EV adoption. The company's plan to roll out 1,000 new swap stations annually further underscores its commitment to this technology. For new investors, the current valuation and mixed earnings performance suggest a wait-and-see approach might be prudent. However, existing shareholders may find reasons to remain invested due to the company's long-term growth catalysts and strategic positioning in the EV market. With all these developments unfolding, it's clear the EV landscape is incredibly dynamic. Let's quickly recap the biggest stories we covered today. And that's a wrap on today's electrifying updates. We saw a major brand confirm its arrival on a new continent, analyzed significant shifts in sales performance for a key EV player, got the inside scoop on a brand's ambitious global expansion plans, and broke down the critical financial data impacting a major automotive stock. Don't miss out on future insights. Hit that like button, Subscribe to Electro Drive News, ring the notification bell, and let us know your thoughts in the comments below. For more exclusive content and real-time updates, follow us on all our social media channels. Stay charged, stay informed, and we'll see you in the next episode.